Have you ever peered into the seemingly complex world of banking and wondered what truly happens when a loan, just goes bad? It's far more intricate and, frankly, pretty fascinating than just a missed payment showing up. Today, we're sort of becoming financial detectives, embarking on a deep dive into what the industry calls non-performing assets, or NPAs. Think of them as maybe the hidden vulnerabilities within the financial system. And we're going to uncover how banks really keep a close eye on and manage the risk of not getting their money back. Our mission today is to demystify how the Reserve Bank of India, the RBI, defines these bad loans, the critical warning signs they look for, and importantly, what banks actually do when a loan turns sour, which involves a crucial concept called provisioning. By the end of this deep dive, you'll hopefully walk away with those aha moments, understanding the foundational health of our financial system in a way that's, comprehensive and hopefully jargon-free. We've sifted through RBI guidelines, real-world examples, all that stuff to make this complex topic clear. So to start our investigation, let's unpack this. What exactly is an NPA at its core?
Okay. So simply put, an NPA, a non-performing asset, is just a loan that has stopped generating income for the bank. That's the bottom line. The fundamental rule, the main trigger, is when the borrower fails to pay either the interest or the principal for more than 90 days.
More than 90?
Yeah, that 90-day mark is a strict, pretty unambiguous threshold for most loans. Once you cross that line, the loan is officially an NPA.
Okay, that 90-day rule sounds straightforward enough, for like a standard home loan or maybe a car loan, but banks deal with a huge variety of credit products, right? Complex business facilities, agriculture loans. And here's where it gets really interesting, I think, because that 90-day rule isn't always just counting days on a calendar, is it? What about those other types of credit?
You're absolutely right. It gets more nuanced. The RBI's guidelines, the IRACP guidelines, they're incredibly granular. And that's because different financial products just have different risk profiles, different payment structures.
Makes sense.
Yeah, so it's not just about a simple missed payment sometimes. It's about understanding the specific ways things can go wrong for each type of loan so nothing falls through the cracks. Let's take cash credit, CC, or overdraft OD accounts. These are really common for businesses.
Right. Working capital lines.
Exactly. They aren't about fixed EMIs. Here, a loan becomes an NPA if it's considered out of order for 90 days.
Out of order? Okay, what does that mean in bank speak?
Well, out of order basically means the account isn't behaving normally. It's showing signs of stress. This could be if the outstanding balance is continuously more than the sanctioned limit for 90 days.
Okay, so they're constantly overdrawn past their limit.
Precisely. Or another trigger could be if there are no fresh deposits, no credits coming into the account for 90 days.
Like the account is dormant.
Sort of, yeah. Or maybe deposits are being made, but they're just not enough to cover the interest being charged. That's the third way. Also for 90 days.
Right, so even if money comes in, it's less than the interest piling up.
Exactly. Imagine a business, say, with a 10 lakh CC limit. If their balance is stuck at 10.2 lakh for 90 days straight, that's case one. Or if they make absolutely zero deposits for 90 days, case two. Or maybe they deposit only $10,000 over 3 months, but the interest charged was, say, $20,000 a month, so you're $60,000 total. That's case three.
Got it. Any of those for 90 days?
Any of those conditions persisting for 90 days makes the account out of order. And once it's been out of order for that 90-day period, boom, it's an NPA. And critically, the bank has to stop booking interest income on it.
Okay, that's clear for CSOD. What about other complex things like securitization?
Right, securitization transactions. So this is where banks bundle up loans, sell them to what's called a special purpose vehicle, or SPV. The SPV then issues securities, like bonds, to investors backed by those loans.
Okay.
Sometimes the originating bank provides a liquidity facility. It's basically backup cash for the SPV, just in case it has a temporary shortfall paying its investors. Now, if the SPV draws down on that liquidity facility, uses that backup cash, and then doesn't repay the bank within 90 days.
Then that amount becomes an NPA for the bank.
Exactly. The specific amount drawn and not repaid becomes an NPA on the bank's books.
Interesting. So it's not just the original loans, but even these kinds of support facilities.
Precisely. And there are specific rules for others, too, like bills purchased or discounted. It's 90 days past the due date if the payment isn't received. Agricultural loans are different, going to tie to crop cycles. It becomes an NPA if it's not paid for 2 crop seasons for short-duration crops or 1 crop season for long-duration ones.
So it really depends on the nature of the loan.
It does. The main takeaway is that the RBI tailors these NPA rules very specifically to reflect the risk and cash flow patterns of each type of credit. It's a pretty robust framework. Now, really importantly, Before a loan even gets to that NPA stage, there's an early warning system.
Okay.
It's called special mention accounts, or SMAs. Think of these like the check engine light for loans. They track signs of stress before it becomes a full-blown problem.
Early warning. I like that analogy.
Yeah. So for standard term loans, like your home loan example, there's a clear progression based on how overdue the payment is. SMA 0. That means the payment is just 1 to 30 days overdue, just starting to show stress. If it crosses 30 days, but is still less than 60 days overdue, it bumps up to SMA 1. And then from 61 days all the way up to 90 days overdue, it's SMA 2. This is the highest alert level. It's really on the brink of becoming an NPA.
Okay, so 0, 30, 31, 60, 61, 90, SMA 0, 1, 2. What about for those revolving credits like the cash credit we talked about?
Good question. For CCOD, it's tied back to that out-of-order status. If the account has been out of order for 31 to 60 days, it's classified as SMA 1. If it stays out of order for 61 to 90 days, then it's SMA 2.
So similar time frame, just linked to the specific stress indicators for that product.
Exactly. And banks don't just track this internally. They are mandated to report these SMA classifications monthly to a central database called CRIST-REAL-C, the Central Repository of Information on Large Credits. This applies for borrowers who have total loans of 50 million, that's 5 crore or more. They report details monthly and any actual defaults weekly.
Wow, okay, so there's central tracking too. It's like a health alert system for significant loans, giving regulators and other banks visibility. So if I'm understanding this right, SMAs are this sophisticated early detection system. It gives banks a heads up, a chance to step in quickly.
That's precisely the idea. It's like a medical alert, as you said. Let's take that business loan example again. Say they miss an EMI due March 1st. By the end of March, maybe March 31st, if it's still unpaid, it's SMA 0.
Right.
Still unpaid by the end of April. Now it's SMA 1.
Okay.
Still unpaid through May, by May 31st. Now it's SMA 2. High alert.
And then June 1st hits, it's been over 90 days.
And bang, it crosses that 90-day mark, becomes a full NPA, but that SMA 2 classification in May gave the bank that critical 30-day window.
A window to do what, though? In practice, how often can banks actually fix things when an account hits, say, SMA 2, before it tips over into NPA?
That's a really practical question, and it's exactly why the system exists. Look, not every SMA 2 account can be saved, obviously, but it gives the bank that crucial 30-day period to actively engage with the borrower. Understand the problem. Is it temporary? Is it structural? And then try to implement what they call corrective actions. Maybe that's a temporary payment adjustment, maybe a deeper financial review, maybe restructuring talks start early.
So it's proactive troubleshooting, essentially.
Exactly. It's designed specifically to minimize the number of loans that ultimately do deteriorate into full NPAs. It's about intervention. Okay, so let's say intervention doesn't work or isn't possible, and the loan does become an NPA. What happens then? Does it just stay NPA? No, it gets further categorized. This is based on how long it's been an NPA and, critically, the perceived chances of actually recovering the money. First, it becomes a substandard asset. This means it's been an NPA for up to 12 months. There's still considered to be some hope of recovery, but it's definitely diminished.
Okay, substandard for up to a year.
Right. If it remains in the substandard category for 12 months or more, it then gets downgraded further to a doubtful asset.
Doubtful. Sounds, well, doubtful.
It is. At this stage, the risk is considered high and the chances of recovery are pretty low. The collateral might be eroding, the borrower's situation worsened, and then the most severe category is a loss asset. This is when the bank, or sometimes the RBI auditors, determines the loan is essentially completely unrecoverable. It's basically worthless on the books.
Worth almost zero. Well, not necessarily written off yet.
And not formally written off the books entirely, maybe, but for internal assessment and provisioning purposes, it's considered a loss.
So what does all this classification mean for the bank's own financial statements? You mentioned they stopped booking interest income earlier.
Yes, that's crucial.
Are they just sitting there accruing potential interest on these doubtful or loss assets in some hypothetical account? That sounds like it could really inflate profits artificially.
You've hit on a critical point of accounting integrity. Once a loan is classified as an NPA right from day 91, the bank must immediately stop recognizing interest income on that loan in its profit and loss statement, period.
Stop cold turkey.
Absolutely.
Yeah.
And not only that, any interest that was previously accrued, meaning charged to the borrower's account, but not actually collected in cash, that also has to be reversed out of the bank's profits.
Reversed. Wow. So it directly hits their bottom line.
Directly. They can and do track the interest that should be accruing off book, maybe in what's called a memorandum account, just for tracking purposes. but it does not hit their official income statement unless and until the borrower actually pays that overdue interest in cash.
That makes sense. Ensures the reported profits reflect actual cash received, not just theoretical earnings from bad loans.
Precisely. It maintains the true and fair view of the bank's financial health. And just a quick side note on consortium loans, where multiple banks lend together to one big borrower.
Ah, yes, shared loans.
Right. For these, each bank in the consortium has to individually track the repayment of its specific share of the loan. So if Bank A doesn't receive its portion of the EMI, even if the lead bank or Bank B did get paid, Bank A still has to classify its portion of the loan as an NPA based on its own receipts.
Interesting. So one bank's NPA doesn't automatically make the whole loan NPA for everyone, but each bank has independent responsibility.
Exactly. You can't just rely on the lead bank's assessment. You need your own vigilance.
Okay, this paints a pretty stark picture. Loans go bad, they get classified, income stops. Banks sound quite vulnerable if a lot of loans sour. How do they build a fortress around themselves? How do they prepare for these inevitable losses? This is where provisioning comes in, right? That's the safety net.
Exactly. Provisioning is the mechanism. It's how banks prepare for and absorb loan losses. Essentially, provisioning means setting aside a portion of the bank's profits to cover potential defaults.
Setting aside profits.
Yes, it's a mandatory requirement from the RBI. Think of it as a financial buffer, ensuring banks aren't caught completely off guard when loans inevitably go bad. And here's a really crucial insight about provisioning. It's primarily an accounting entry.
Accounting entry. So it's not like they're taking physical cash and putting it in a separate vault labeled bad loan fund?
No, not quite like that. It's more like creating a reserve on the balance sheet. Think of it like your personal budget. You know you have a big expense coming up next month, right? So you mentally, or maybe in your spreadsheet, you set aside that money. You don't spend it, even though it's still technically in your account. You've allocated it.
Okay, I get that analogy.
Banks do the same with their profits through provisioning. They recognize the potential future loss now, reducing their current reported profit to reflect the realistic value of their loan portfolio. It prevents them from showing inflated profits based on loans that might not pay back.
Right, so it makes their balance sheet more realistic about the true value of their assets. How much do they have to set aside? Is it a fixed amount?
No, it varies significantly, and this is key. The amount they need to provision is directly linked to the perceived risk of the loan. For healthy, standard loans, the ones paying on time, the provisioning requirement is actually very low, often less than 0.5%, maybe 0.25% for SME loans, 0.40% for others.
Tiny, because the risk is low.
Exactly. It just acknowledges that even good loans have some minimal inherent risk.
Mm-hmm.
But as a loan's health deteriorates and it slips into NPA categories, those percentages jump up significantly. Yeah. For a substandard asset, remember, NPA, for up to 12 months, the bank might have to provision, say, 15% if the loan is secured by collateral, and maybe 25% if it's unsecured.
Okay, a noticeable jump.
Definitely. And then, if it degrades further into a doubtful asset where recovery chances are much lower, the provisions escalate sharply. For doubtful assets, it depends on how long it's been doubtful and whether it's secured. It can range from 25% initially up to 40% after a year, and even 100% if it's been doubtful for more than 3 years, or if it was unsecured to begin with.
100% for unsecured doubtful or long-term doubtful. Wow.
Yes, and finally, for a loss asset, the ones deemed totally unrecoverable, the provision is a full 100%. No ambiguity there.
So the sliding scale basically forces banks to progressively acknowledge more potential loss as the actual risk of non-recovery increases.
Precisely. It ensures their financial buffers match the evolving risk profile of their loan book. Now, when you look at a bank's overall health report, you'll often hear two terms: gross NPA and net NPA.
Right. Heard those. What's the difference?
Gross NPA is simply the grand total of all loans classified as non-performing, substandard, doubtful, and loss assets combined. It's the total bad loan amount. Net NPA, on the other hand, is the gross NPA figure, minus the provisions the bank has already made specifically against those NPAs.
So net NPA shows the bad loans after accounting for the safety cushion they've built.
Exactly. It gives a sense of the residual uncovered risk. And related to this is the provisioning coverage ratio, or PCR. PCR is calculated as the total provisions held against NPAs divided by the total gross NPAs.
Okay, so what percentage of the bad loans are covered by provisions?
Correct. The RBI actually requires banks to maintain a pretty robust PCR, generally around 70%.
70%. So they need provisions covering at least 70% of their gross bad loans.
That's the benchmark, yes. It ensures banks are adequately prepared for potential write-offs and aren't overly exposed. Now, one more detail on provisioning. If a loan happens to be covered by certain government or institutional guarantees, the bank doesn't need to provision for the guaranteed portion.
Oh, interesting. Like what kind of guarantees?
Well, for example, there's the ECGC, the Export Credit Guarantee Corporation of India. It protects banks and exporters against losses from non-payment by foreign buyers. If a loan is, say, 90% covered by ECGC, the bank only needs to worry about provisioning for the remaining 10% risk.
Okay.
Another big one is CGTMSE, the Credit Guarantee Fund Trust for Micro and Small Enterprises. This scheme encourages lending to small businesses by providing guarantees on collateral-free loans, often covering 75–85% of the loan amount.
So these guarantees reduce the bank's direct exposure.
Exactly. They reduce the risk for the bank and therefore reduce the amount of capital they need to tie up in provisions for those specific loans. Okay, so banks classify NPAs, they provision for them. What else is in their toolkit? Are there rules about trying to fix the situation? Yes, absolutely. There's a revised resolution framework. The key thing here is timing. Once a loan defaults, banks have a 30-day review period. After that, they need to start implementing a resolution plan.
A plan to fix it, okay. What if they delay?
There are penalties.
Yeah.
If a resolution plan isn't implemented within 180 days of the default, the bank faces an additional provision of 20% on the loan.
Ouch.
And if it's still not resolved after 365 days, there's another 15% provision slapped on. That's a total of 35% in extra provisions just for delays in resolution.
So strong incentive to act fast.
Very strong. The framework pushes for timely action. Now, a really serious issue banks watch for is willful default.
Willful default. That sounds worse than just being unable to pay.
It is. Willful default isn't about inability. It's about unwillingness or misconduct. It means the borrower has the capacity to pay, but is choosing not to. Or it could mean they've diverted the loan funds for other purposes, siphoned the money out, or sold off the assets pledged as collateral without the bank's knowledge or permission.
Okay, that's clearly fraudulent behavior.
Absolutely. And it's treated very seriously. There's a specific rule. If a director of a company is identified as a willful defaulter in connection with one company, banks have to be extra cautious with any company where that person is also a director. In fact, they might have to make a 5% provision on loans to those other companies, even if those loan accounts are currently standard and paying on time.
Wow, a 5% provision just because of a director's association with a willful default elsewhere. That's a significant red flag contagion effect.
It is. It reflects the heightened risk perceived when dealing with individuals flagged for such conduct.
Now, before things get that bad, you mentioned resolution plans. Does that include things like restructuring the loan, giving the borrower a bit of breathing room?
Yes, definitely. Restructuring is a key strategy within resolution. It's a way banks can work with a borrower who is facing genuine difficulty. It involves modifying the original loan terms. Maybe they reduce the EMI amount and extend the repayment period. Maybe they offer a short moratorium on payments. Sometimes they might even approve additional funds if it helps the underlying business recover.
So it's a pragmatic approach, trying to help the borrower get back on track.
Exactly. It's often better for both the borrower who avoids default and the bank who avoids a potential total loss and the heavy provisioning that comes with it. It's about finding a sustainable path forward, if possible.
Okay, so we've covered NPAs, SMAs, classifications, provisioning, resolution, even willful default. It's a complex system. What does all of this, the NPAs piling up, the money set aside for provisioning, what does it ultimately mean for the bank itself, for its fundamental health and stability? This all ties into something called the capital adequacy ratio, or CIR, doesn't it? That seems to be the ultimate score.
It absolutely does. CRR is the linchpin, really. The capital adequacy ratio is one of the most crucial metrics for assessing a bank's financial strength and resilience. Think of it as the bank's health report card. It's calculated by taking the bank's total capital, which is broadly split into Tier 1 capital, core equity, retained earnings, and Tier 2 capital, supplementary capital like certain reserves and debt instruments,
Okay, capital on top.
divided by its risk-weighted assets, or RWA. Now, RWA isn't just the total assets, it's the assets weighted according to their riskiness. A government bond might have a 0% risk weight, a standard home loan may be 50%, but an unsecured loan or an NPA might carry 100% or even higher risk weight.
So riskier assets count more in the denominator.
Precisely. So CIR, Tier 1 plus Tier 2 capital risk-weighted assets. Its purpose is to show how much of a capital cushion the bank has to absorb potential losses relative to the amount of risk it's taking on through its lending and investments.
And there's a minimum required level.
Yes, the RBI mandates a minimum CRR for all banks. Currently, it's 9%, plus some additional buffers like the capital conservation buffer, pushing the practical minimum higher for many banks. This ensures they can withstand significant financial stress without failing.
Okay, so how do NPAs and provisioning mess with this crucial CR ratio?
They hit it negatively from both sides of the equation, the numerator, capital, and the denominator, RWA. It's a double whammy. Firstly, when a loan becomes an NPA, its risk weight typically jumps up significantly. As we said, it might go from 50% to 100% or 150%. This increases the total risk-weighted assets, the denominator. A bigger denominator automatically pushes the LRI down.
Okay, makes sense. More risk of lower ratio.
Secondly, NPAs hurt the capital numerator. How? Well, remember, banks stop recognizing interest income on NPAs. That reduces profits. And even more directly, the act of provisioning is an expense that comes straight out of profits. Lower profits mean less money goes into retained earnings, which is a key component of Tier 1 capital.
So provisioning directly reduces the capital available in the numerator?
Yeah. Exactly. Less capital on top, more risk-weighted assets below both factors work together to decrease the bank's CR.
Can we use a simple example, maybe?
Sure. Let's say a bank starts with 5,000 crore in capital, and its risk-weighted assets are 10,000 crore. Its CRR is 1,000 crore. Its goal is 10%. Healthy, above the minimum.
Okay, 10%.
Now, imagine a chunk of its loans become NPAs. Let's say this increases its RWA to 11,000 crore due to higher risk weights. That alone drops CRR to 1,000, 11,000 equal 9.09%. Already borderline. But wait, the bank also has to provision for these NPAs. Let's say the required provisioning reduces its profits, therefore its capital, down to 900 crore.
Okay, capital down, RWA.
Now, the CR is 911,000, or roughly 8.18%.
Below the 9% minimum.
Exactly. In this scenario, the bank would be undercapitalized according to regulations. It would be forced to take corrective action, like raising fresh capital, which can be difficult and expensive, or shrinking its loan book, particularly risky loans, to reduce RWA. It's a major challenge.
That really illustrates the impact clearly. Do you have a real-world example?
We can look at public data. For instance, Punjab National Bank, PNB. As of March 31st, 2024, their reported CRR was 15.97%. Quite comfortable, well above the minimum. Their core equity Tier 1 capital ratio, the highest quality capital, was 11.04%. Also strong.
Okay, so they're well capitalized.
Yes. And you can also see their provisioning actions. In the financial year ending March 2023, they made provisions of 3,624 crore. The year before, ending March 2022, it was 4,563 crore. This shows how a large bank actively manages these issues. They recognize NPAs, they make substantial provisions year after year to absorb the expected losses, and despite that profit impact, they work to maintain a robust KR. It's a continuous balancing act.
Wow, what a journey we've really been on, from just a simple delayed payment all the way to the intricacies of a bank's core financial health. We started by unpacking what an NPA truly is, that critical 90-day threshold mostly.
It's the starting point.
And then explored how those rules adapt for different kinds of credit, like cash credit or agri loans, highlighting the very detailed oversight the RBI has.
Quite granular.
Then we saw those vital early warning signs, the special mention accounts, SMAs, those alerts giving banks a chance to step in before things really escalate.
SMA 0, 1, and 2. The pathway to potential NPA.
From there, we uncovered the different levels of, well, bad a loan can be, right? From substandard to doubtful to outright loss assets, and how banks crucially stopped recognizing income on these troubled loans.
Which protects the integrity of their profit reporting.
Absolutely. Then, critically, we took that deep dive into provisioning, understanding it as the bank's financial safety net, essentially an accounting entry reserving profits to cover those potential losses, with specific percentages tied directly to the loan's risk level.
More risk, more provision.
And finally, we tied it all back to the really big picture, how NPAs and provisioning directly impact a bank's capital adequacy ratio, the CIR, that ultimate measure of its resilience and its ability to absorb financial shocks.
Bring it all together.
So for you listening, whether you're maybe a borrower yourself or an investor looking at bank stocks or, just someone trying to stay informed about the economy, understanding these concepts, NPAs, SMAs, provisioning, CIR, it really helps you grasp the foundational health of the entire financial system. It's complex, yes, but it's such a critical piece of the economic puzzle. Impacts everything from lending rates to overall growth.
It really does underpin so much.
So we'll leave you with this thought to mull over. Given this really intricate web of rules, these early warning systems, the mandatory safeguards like provisioning and capital requirements, What does this all tell us about the delicate balance banks and regulators have to strike? That balance between supporting economic activity through lending, which we need, and ensuring the stability and soundness of our financial institutions. And maybe think about what might be the ripple effects if NPAs start rising significantly or falling. How could that impact the broader economy? Or perhaps even touch your own financial future? Something to ponder.